Alright, so learning objective 6 talks about journal entries for a manufacturer's job costing system. You may say, well, this is managerial accounting, cost accounting, why should I do the financial statements or maybe journal entries? Well, the thing is, if you're a cost accountant, okay, you have to know the process so that you can extract useful data, especially about a cost, so that you can complete a cost analysis report. So let's kind of go through the journal entries for the manufacturer's job costing system. So this flow chart is super nice, to be honest. It explains pretty much everything. So when you have when you purchase raw materials, definitely you're going to go through some journal entries. Then you have to deal with the raw materials inventory. You have a purchase, which will increase the balance, right? That's going to be debit. And you're going to use raw materials. Then you're going to post a credit, right? And you also have the factory, so-called WIP inventory. So there will be cost flow into the factory. And also you have labor cost flow into the factory. So there are a lot of journal entries you have to post, right? And also, if you look at the manufacturing overhead, that's a big monster. So you have a big bath, okay? It's a big pool. You have to, if you have indirect materials used, you have to put that into the overhead. If you have indirect labor, you have to put in the overhead. If you have whatever manufacturing costs that are indirect, you have to put into that manufacturing overhead pool. Then you do the allocation. So this is the manufacturing overhead account. Is actually I would say the most active account in the manufacturing process, because you have a lot of inflow, like indirect material, indirect labor, and other indirect costs. You also have outflow because you have to allocate manufacturing overhead to the jobs. Then finally, you have finished goods inventory. When you transfer the finished products to the warehouse of finished goods, then there will be cost flow. You have to do the debit, credit. And finally, when you have sales, you are going to have an income statement. These accounts, you have sales revenues recognized, and also the CGS recognized in the meantime. So this flow chart is super nice. Please take your time to go through all these interesting processes, and also kind of imagine, okay, I have a lot of journal entries I have to deal with. Okay. So next few slides, we're going to go through these journal entries together. It's going to be a lot of fun, trust me. You probably have seen them in financial accounting, which is super, super plus. If you have, forgotten some of them, it doesn't matter as long as you still remember debit, credit, these issues. So I'm going to walk through all these accounts and give you a pretty nice introduction about these, journal entries. So let's assume that there's a Life Fitness company. Then I think we covered this company in the prior slides. There are a lot of job orders we talk about, so don't worry, we're going to use all these numbers again and work out all these journal entries together. So first, let's focus on raw materials. So the first one is purchase. So the company feels that, okay, I don't have enough raw materials to complete my production. I'm going to buy raw materials from supplier. So during December, this company ordered and received 90,000 of raw materials. So then you can see that this 90,000 raw materials will increase my raw materials inventory balance, but also I have liabilities I have to pay the suppliers. Okay, let's assume that I purchased raw materials on account, so I'm going to end up with the accounts payable. That's my liability. And therefore, you're going to post a debit to raw materials inventory with 90,000, and you have accounts payable that will receive 90,000 credit there. So you have a raw materials inventory, accounts payable, and so on. So next is let's assume that the Life Fitness used direct materials, okay, in its production, and the value is 112,000. Because of that, there will be cost outflow from raw materials inventory. So raw materials inventory, that's a debit account. It must receive actually a credit because you have cost outflow. So in order to reflect that, you have to post actually a credit to raw materials inventory. That's about 112,000. And the cost of 112,000 will flow into the factory. That's your manufacturing cost now. So that working process inventory will receive 112,000 cost. So that's going to be a debit for that. The work in process inventory is a debit account, and you actually flow the raw materials into this factory. Definitely that will increase its balance. You should receive a debit for sure, right? So that's the reason you see the debit for the work in process inventory in the factory, and you see the credit for the raw materials inventory. So don't forget that the left is left column, that's the debit, the right column, that's credit. Let's also assume that the Life Fitness used 2,000 of indirect raw materials, such as glue, right? Such as maintenance, whatever parts. So the 2,000 indirect raw materials actually will become manufacturing overhead. So the 2,000 will flow into the manufacturing overhead cost, and you also have a deduction in your raw materials inventory because you're going to use indirect raw materials in your manufacturing as a manufacturing overhead cost. So the manufacturing overhead cost, manufacturing overhead account receives 2,000 debit, and the raw materials inventory receives 2,000 credit. Okay, so that's what we have here. So let's come to the labor part. Assume that Life Fitness incurred 30,000 of direct labor on jobs, and then the working process will receive the debit because you have a cost flow, the labor cost flow. And in the meantime, because you use the labor, you have to pay, right? It's a direct labor, so you're going to pay the workers 30,000 directly. And sometimes we don't pay them cash right away. We pay them cash every month. So if it happens in the middle of the month, you may, hey, I'm going to give you a wages payable. Maybe this is the second week of the month. I'm not going to pay right away. I will pay you the last day of this month. So I'm going to accrue this cost called a wages payable. So again, that's my liability. So you can have 30,000 credit posted to the wages payable, okay, and you're gonna post the 30,000 debit to the work in process inventory. So you can see that work in process inventory increases again by 30,000 because now you flow the labor cost into this factory, okay, to do your manufacturing. And also you may have indirect labor on the jobs. For example, machine maintenance, right? Machine maintenance salaries, and or maybe the janitor's salary, who cleans the floor of your factory, whatever. So then the 13,000 indirect labor cost will become your manufacturing overhead cost. And also you have a wages payable, which is 13,000 there, and it's similar to the direct labor, but the difference is the debit. Each debit actually is posted to different account. Okay, so just keep that in mind. So next we are going to talk about other manufacturing overhead costs, so like depreciation, utilities, insurance, property taxes, and so on. So I mentioned that all these costs are part of your manufacturing overhead. So you have 3,000 utility bills, right? Okay, so that's your liability, okay, payable. Depreciation 4,000, so you have accumulated depreciation increase by 4,000. Insurance payment 1,000, and plant property tax payable 2,000. So together we're looking at a 10,000 increase in the manufacturing overhead. So I want to emphasize that so far we have not talked about allocation. Don't worry about it. We're going to come back to that. But I want to go back to the first 3 slides to tell you that what's happening for the manufacturing overhead. So this raw materials inventory 2,000. Okay, 2,000 here. That's the actual manufacturing overhead. Labor, we are looking at 13,000 actual manufacturing overhead. And when I come to this slide, other indirect manufacturing overhead costs, there is a 10,000 actual manufacturing overhead, okay, during the period. Okay. Then the next is about allocation. Okay, so and now let's take a look at allocation part. So assume that the job. There are 2 jobs, and they are using 5,000 direct labor hours and 1,000 direct labor hours respectively. And also, let's say that we're super lucky and we're given $16 per direct labor hour as predetermined manufacturing overhead rate. So we can apply this predetermined manufacturing overhead rate to each job according to their actual direct labor hours. So simply you multiply 16 by 500 and 16 by 1,000 respectively. So you can find their you can find allocated manufacturing overhead cost. So now I have a manufacturing overhead pool. I'm going to allocate 24,000 out of whatever number to the work in process inventory. Okay. So if you go back to that flow chart, so I'm going to allocate 24,000 out of this big pool to this WIP to calculate estimate manufacturing overhead, to find out the estimated manufacturing overhead allocated to this job. So finally, the manufacturing cost in total. Okay, so this allocation journal entry is very simple. So you are going to move whatever cost from manufacturing overhead to the working process, and once again it's allocation. So you may not use the entire manufacturing overhead balance. You may use a part of that, or maybe you use all of them. You have to even borrow. Okay, so then you end up with the over or unallocation issues. Remember in the learning objective 5 we talk about the over and under allocation issues, right? So this may happen like that. So I hope you can think about, imagine that, okay, I have one pool, so you know, in one way I'm going to dump a lot of indirect labor, indirect materials, and other manufacturing overhead costs, including depreciation, property taxes, whatever, into that big pool. And on the other hand, I'm going to allocate accumulated costs in the manufacturing overhead pool and put that to the work in process inventory. I may use everything in that pool, okay, and still have something left over. I may have to use all of them and even borrow something from somewhere to put in the work in process inventory. That may happen. So you end up with the overall unallocation. So now what we have here is, let's assume that, okay, the job 603 had a total cost of 58,000, and the job 604 had a total cost of 108,000. So let's assume that that's what we have. Okay, so we are looking at final process. Okay, so we have some products manufactured and transferred to finished goods inventory. So a lot of products will be moved from the factory to the warehouse. So these products, they carry values. Okay, so we have to flow their cost into the finished goods inventory. That's how you end up with this journal entry. So because there you have the cost outflow from the working process inventory, so you have to post a credit to show that reduction. In the meantime, you have new products joining the finished goods warehouse, so you should expect an increase, which is a 166,000 increase, right? So you're going to see the increase there, so you have to post a debit, okay, to post a debit. So this is what I mean by remove the completed jobs out of the factory and into the finished goods inventory. Okay, finished goods inventory. So now you can actually go a step further. Let's assume that we can sell these units. Right? We can sell these units. So you may sell 40 cross trainers from job 603 at a price of 1,425 each, and all 60 treadmills from job 604 at a price of 2,500 each. So now you can compute accounts receivable by multiplying 40 units by 1,425 plus 60 units multiplied by 2,500. So together you have 207,000 accounts receivable balance, right? So then you're going to recognize all the sales, the sales of these units. That's the sales revenue you have. So that's sales revenue you have. So you have this journal entry to record the sales. However, don't forget that when you have sales, there are two journal entries you have to record. According to financial accounting, guidelines, when you have sales, you have to recognize two journal entries. Number one, you're going to recognize the sales, but in the meantime, you have to expense. You have to recognize the CGS. Okay, so therefore there will be two journal entries. Number one, you're going to have a sales revenue recognized. In the meantime, you're going to have CGS recognized. So the next journal entry, you're going to see the CGS part. So we can see that, let's assume that it will cost us 1,116 to manufacture one cross trainer, and it will cost us 1,800 to manufacture one treadmill. So you multiply 40 and 60 by each price respectively. So together the CGS is 154,400. So you are going to recognize CGS, and also you're going to move the finished goods inventory, the products from the finished goods inventory warehouse, right, to the deliver them to the customers. So therefore you have to reduce the finished goods inventory, okay, by that amount, and recognize the CGS in your income statement, so that with the sales revenue recognized and the CGS recorded, you can figure out, okay, what is profit margin? Okay, sorry, what is gross margin or gross profit? Okay, so go from there. So these are sales of units. These two slides are more like financial accounting part. So you have the sales revenue recognized as well as the CGS recorded. Okay, so next we can even be more aggressive. And what if we have operating expenses? So if we have that, we can go from sales revenue, CGS, gross profit, operating expenses, finally operating income. So you can take a look at what's happening here. So we have salaries and commission expense 20,000. We have rent expense 3,300. We have marketing expenses 9,400. So all these expense accounts, we know that they are debit accounts and they should receive debits. Okay, and you have a lot of payables. Okay, the payable accounts, so they are credit accounts, so they should receive credits. Okay, so and these are operating expenses. Okay, so finally we can review allocation issues. So we may have overall and allocations, whatever. So we have to take a look at what's happening here. So you have the same manufacturing overhead account. So in one side you have actual, you have indirect materials 2,000, indirect labor 13,000, and other 10,000. We know that. Okay, so that's about 25,000 actual, right? And you have allocated 24,000 to job 603 and job 604, and 8,000 to job 603, and 16,000 to job 604. So you do the allocation, and it turns out that we have 1,000 manufacturing overhead cost left. So which means we are actually under allocation. The actual spending is 25,000 for manufacturing overhead, and for some reason we have only allocated 24,000 to these two jobs. So we are under allocated, right? So we have to allocate it more. So therefore there is 1,000 debit left. We better wipe that out. So we are going to post a credit 1,000 here to wipe out the manufacturing overhead balance, so that whatever actual expense should be completely allocated to these two jobs. You should have zero balance in the end of your manufacturing overhead account. So since you have 1,000 debit, I'm going to post a credit to wipe it out. So to balance this journal entry, I must post this 1,000 debit correspondingly to the CGS. So the CGS receives 1,000 debit and the manufacturing overhead receives 1,000 credit. So the way to figure out this journal entry is you start with the manufacturing overhead account. You look at, okay, what is any balance? If it's a debit, I'm going to post a credit to close it. If it's a credit balance, I'm going to post a debit. Then you go from there to figure out, okay, I have to write off CGS anyway. What I'm supposed to do? Should I go with the CGS debit or credit, right? So, but anyway, whatever you choose, you have to make sure this journal entry is balanced. So in this case, your any balance is 1,000 debit. So I have to post a credit. So that's why I started with the manufacturing overhead 1,000 credit. And I have to balance this journal entry. I know the CGS must be there, so the CGS has no choice but to receive 1,000 debit. Okay, so that's how you finish this manufacturing overhead account. Okay, so finally we can happily come up with this income statement. You have sales revenue, so feel free to go back to the prior slide to pull out the number. We are looking at 207,000 sales revenue. Then the CGS, also you can go back to the prior slides to figure out this number. Then we will find the gross profit. Then we have operating expenses. So finally we can have operating income. Okay, so I hope you enjoy all these journal entries and also kind of review how to get the income statement. So the learning objective 6 is a little bit challenging because we need to use a lot of information and concepts, knowledge from the financial accounting. But hopefully this review give you some insights into, okay, where I have job costing and also allocation, manufacturing overhead allocation, how I'm going to deal with the challenges involved. So I hope you enjoy the video lecture, and feel free to talk to me if you have any questions. I love to go through these processes again with you until you understand all of them. Okay, so feel free to talk to me if you need any help. And all right, thank you, and I will talk to you next time. Bye.